Friday, May 6, 2010. It began in a fraction of a second. At 2:42 p.m., the Dow Jones Industrial Average, the bedrock of the global economy, plunged. $1 trillion vanished from the market in minutes. The system wasn't malfunctioning. It was broken. Within 5 minutes, prices for nearly every stock became completely detached from reality. General Electric traded at 1 cent. Accenture traded at $40,000. The source was not a terrorist attack or a national crisis. It was a single anonymous figure operating from a quiet London suburb. His name was Navinder Sarao, a lone trader who never set foot on Wall Street but controlled its every tremor. Before he became the world's most wanted financial criminal, Sarao was an unremarkable futures broker. He believed the stock market was rigged. He was right. The 21st century market moved at the speed of light, governed by high-frequency trading, HFT firms. They used powerful algorithms to execute trades in microseconds, faster than any human could react. Sarao didn't want speed, he wanted control. He spent years building the only algorithm designed not to be fast, but to lie, to trick the machines that ran the world. The strategy was called spoofing. It worked by creating a sudden, enormous false demand. Sarao would send 10,000 contracts per second, simulating an order worth $200 million. This massive fake wall of demand convinced automated systems that the price was about to skyrocket. They would rush to sell, and in that split second, Sarao would buy all of their stock at the low price. Then, before the market could process the truth, he would instantly cancel his fake $200 million order. For nearly 5 years, Sarao ran his scam like clockwork. Every morning at 8 a.m., the HFT firms knew he was coming. They knew the price would briefly drop, but they couldn't stop it. He was playing a zero-sum game. Every million he made was $1 million lost by the most sophisticated algorithms in the world. He was the biggest shark in the ocean, feeding on the high-tech scraps left by automated trading. He left behind millions in profit and a trail of chaos, and for years, nobody could prove how he did it. But the system he broke was his own design. The massive flash crash of 2010 was the moment Sarao's game became a matter of national security. It took the U.S. Commodity Futures Trading Commission, CFTC, nearly 5 years to connect that single catastrophic event to the ghost in London. They were looking for an international terrorist cell. What they found was something much simpler: arrogance. The CFTC built an entirely new system just to track this one phantom. They traced the market manipulation back to a computer in London, but the connection was masked by dozens of complex routing layers. But Sarao, the genius, made a fatal amateur mistake that exposed his physical location. He failed to scrub his unique user ID from a discarded network log file, exposing the server where his code ran. The server's real-world owner was an obscure IT company operating out of a small suburb, Navinder's parents' address. The US Justice Department had him. The man who moved the world's money was brought down by his home Wi-Fi. The dramatic arrest, executed by the FBI and Scotland Yard, brought the chaotic trade floor directly to his family's doorstep. Sarao was charged with 22 counts of wire fraud, commodities fraud, and market manipulation. The trial was not about if he did it, but how he could do it. The prosecution argued that his spoofing was a direct attack on market integrity. The defense argued that Sarao was simply exploiting the exact flaws that high-frequency trading had created. And the final judgment was astonishing. Sarao was sentenced to 1 year of home confinement and probation. He walked free because, in the eyes of the law, he was merely exploiting the very system Wall Street had built. His methods forced regulators to acknowledge a terrifying truth. One man, using one line of code, had been more powerful than every safeguard in the world's most advanced financial markets. But the story of the market ghost doesn't end with a guilty plea. Sarao's conviction forced the CFTC to implement new rules for electronic trading. New laws required more transparency and stricter surveillance of automated orders. The algorithms that had once made the market untouchable were now forced to police themselves. Sarao became a folk legend, a symbol of the individual genius triumphing over the impersonal power of global finance. Yet, his methods were never truly erased. The tools he pioneered live on. The underlying principles of spoofing remain an ever-present temptation in the digital shadows. The dramatic arrest and subsequent trial were about much more than one man's profit. The legal fallout exposed the fragile nature of automated trading and the difficulty in policing a market that moves faster than the speed of light. The prosecution, led by the Department of Justice, argued that Sarao's actions weren't merely illegal, they were a violation of the fundamental integrity of the US financial system. Their evidence was a massive database of Sarao's fake orders, showing he would cancel 19 out of every 20 trades, manipulating the price with zero intent to fulfill the offer. This was the smoking gun that proved intent to defraud, not simply bad trading. Sarao's defense countered that spoofing was prevalent, arguing he was being singled out for doing what dozens of high-frequency trading firms did daily, just more effectively. This forced the CFTC to turn its attention away from the individual and toward the flawed technology itself. New market rules were enacted globally. The Sarao loophole had to be closed. The first major reform was the implementation of disruptive trading practices rules, explicitly outlawing the practice of placing orders with no intent to execute. Secondly, the SEC mandated speed bumps, intentional delays in the execution queue designed to give non-HFT traders a fractional chance to see and react to mass order cancellations. The algorithms that had once made the market untouchable were now forced to police themselves through internal regulatory compliance code. But Sarao's exploits inspired a new wave of digital defiance, proving that the technology of finance was its greatest vulnerability. Across Asia and Europe, new market ghosts emerged, using the same spoofing principles on different markets. In 2017, a trading team in Taiwan was caught using Sarao's exact spoofing patterns to manipulate the Taiwan Futures Exchange, making over $10 million before being shut down. In India, an automated trading unit was caught manipulating the currency market using layered, fake orders in a scandal that caused the rupee to crash by 5% in a single day. This proved that the flaw was not the man, the flaw was the machine. The government's attempts to stop the ghost had only taught the world where the weakest part of the financial algorithm lay, and Sarao himself. His final sentence was lighter than expected. 1 year of home detention and probation, avoiding the maximum 25-year prison term. The reason was simple. The judge recognized that the punishment for exploiting the flaw shouldn't exceed the punishment for creating the flawed system itself. He walked free because, in the eyes of the law, he was merely exploiting the very system Wall Street had built. The true cost was not the financial fine, but the psychological exposure. Sarao became a folk legend in the hacker community, a symbol of the individual genius triumphing over the impersonal power of global finance. Yet, he now lives under constant surveillance, his identity forever linked to a crime that redefined the dangers of the digital age. His methods forced regulators to acknowledge a terrifying truth. One man, using one line of code, had been more powerful than every safeguard in the world's most advanced financial markets. But the story of the market ghost doesn't end with a guilty plea. Sarao's conviction forced the CFTC to implement new rules for electronic trading. New laws required more transparency and stricter surveillance of automated orders. The algorithms that had once made the market untouchable were now forced to police themselves. Sarao became a folk legend, a symbol of the individual genius triumphing over the impersonal power of global finance. Yet, his methods were never truly erased. The tools he pioneered live on. The underlying principles of spoofing remain an ever-present temptation in the digital shadows. Final question. How many more are still trading in the dark?